Hey there, everyone. My name is Ryan Schul. Thanks for stopping by to check out my channel. So, as promised, I'm going to try to focus on financial themes. Okay, I'm going to try to carve out like a little bit more financial, um, make this more like a financial kind of channel, but maybe I'll pepper in a few other random thoughts and ideas as they come to me. So, today's topic is definitely financially based. This is a personalized investment recommendation engine, and I'll just get right into it. Okay. Why would we even need to create a personalized investment recommendation engine, right? Like the reasons are multifaceted. Some of the top ones are um, everyone's situation is unique, right? So what's going to work for me is not necessarily going to work for you, and vice versa. And what works for your aunt or your grandparents or your child or your best friend is not going to work for the rest of those people I just mentioned. Okay. So really, it's based on your age. Things like how much money do you have saved up? How affluent are you? How much money are you able to put away in savings? Things like what is your tolerance for risk? Based on your age, how much time do you have to accumulate wealth, right? If you're a little bit older, you don't have as much time as somebody that's younger, but somebody that's younger maybe is not in a position to save a whole lot of money. Maybe it's they live paycheck to paycheck every week or every 2 weeks, right? So everybody's situation is different. But this type of analysis or this perspective that I'm going to showcase to you should capture most of the scenarios, pretty much most of the scenarios that I can conceive of. Okay, I started my career as a financial planner, wasn't very successful. I loved the whole concept and the business. There was a lot of sales, like selling plans and selling processes and selling. I wasn't a very good salesperson. I was very good at doing all the planning and um, all the financial stuff. I was very good at all that. But I get in front of a client and I couldn't close the deal. That's just not my nature to reach out and grab that money and take it. I was more like the technical person explaining all the nuances and the details of the plan, which is fantastic. I mean, you have to be able to do that, but you still have to get that money at the end of the day, right? You have to, when you sign off on that transaction, you have to collect the money. I didn't really collect a whole lot of money, so wasn't too successful. But I know the nuts and bolts of the business, that's for sure. So reduce reliance on generic advice. This is very customizable and specific to your unique scenario. Okay, we're going to look at a couple different types of processes here: scenario analysis, Monte Carlo simulation, and risk-based asset rebalancing. So that's going to be the focus for today. Empowerment without a financial advisor. Now, if you want to go hire a financial advisor, by all means do so. If you just want to get just a general idea of how these concepts work um, cohesively and integrated into one system, I think this tool is going to give you a good insight into that. Now, financial advisors are great. They can steer you in the right direction. But there's good ones and there's bad ones. You have to do your homework too to figure out who's going to be good, and maybe some focus on your specific scenario, and that's their skill set, right? Because there's all different kinds of planners too, right? So you have to align your interests with the skill set of that advisor. But in any event, like this tool is completely, totally 100% free. And again, I think it's going to give you good insight into the financial planning process. So you can take this knowledge and then present that to a planner and get feedback from them. Like, what do you think? If you just go talk to a financial advisor, then I don't know what the outcome is going to be. I mean, you might spend a lot of time just collecting information and building up your knowledge base, right? A tool like this is going to help you go in armed with useful information that you can present to the advisor, so you don't go in with a blank slate. Okay, behavioral nudging, that's another expectation here or another use case. Long-term projections, confidence intervals, worst case scenarios, right? We're going to look at different probabilities of outcomes. And it's scalable. This concept is scalable for banks, for personal financial advisors, even for apps on your phone. There's all kinds of use cases for this kind of thing. Okay, so let's get into it without further ado. So I'm going to scroll down here. Now we have a couple assumptions that we're going to stick with, and I think this is plausible and very reasonable. Stocks are going to generate around 9% average returns, give or take. Now there's going to be some volatility and some standard deviations of those returns, and I've built that into the model here. You don't just see consistent gains and everything is fantastic and you're making 9% per year every single year for the next 30 years. I guarantee it will not work like that, right? You're going to have good years and bad years. There's going to be ups, there's going to be downs. On average, I think 9% is good for stocks. Bonds around 3.5%, REITs about 7.5%, and CDs about 2.5%, give or take. And again, there's variabilities for all of these. Now, these are the assumptions, so I put this into a model. But if you think like 2.5 is too low for CDs, you can change that, right? You can change these variables. You can change these assumptions. You can make this 8%, maybe 9%. I don't think it's going to be over 8%, to tell you the truth. And I don't think it's going to be under 6. So I think these numbers are a good start. But by all means, if you have a better idea, or you are basically um, interested in changing these input variables, you can totally do that, okay? So let me run the first scenario here, Control Enter, and I'll show you what we're looking at. Basically, if I just take you through code, just a general overview here, we're capturing age, income, investment horizon, risk tolerance, and what is your overall goal here? Is it retirement, wealth growth, income, preservation, things like that, right? So I want to capture these inputs from the user. I'm going to take that, create a user profile, and then if the risk is low, we are going to make these types of recommendations. CDs, 2%, or 20%, bonds, 50%, stocks, 20%, and REITs, 1%. That is going to be the investment allocation based on your tolerance for risk, okay? So if you have high tolerance for risk, zero money is going into CDs, right? More money is going to stocks or REITs. If you have a low tolerance for risk, 20% is going to CDs, less is going into the other asset categories, right? So the total would be 100%, but based on how comfortable you are with the riskiness of these investments, that is going to drive or determine, the allocation of your money that you invest in these different investment instruments, right? So here's the average returns, like I talked about. Here's the standard deviation. So if you don't like these guidelines over here that I'm highlighting, by all means change it. These are the inputs that you can change. So let me go down here. I'm going to enter my age, close to 50. I won't say my true age, but close to 50. So enter annual income. I'm going to put 150K. That is totally lying, right? But just to create a hypothetical scenario here, I'm going to put 150K. I live in New York City. For white collar affluent person, you should be making this. Because of COVID, my income is way lower than that. But I have to make it somewhat reasonable, or the whole scenario is really not going to make a whole lot of sense, okay? But if you're just earning 50,000 and that is your use case, then put that in. My use case is like under 10,000 per year, so that's really not very realistic. Enter your investment horizon in years. So I'm going to say about 25 years. I'm going to say 25 for myself, okay? Enter your risk tolerance. I have a high tolerance for risk because I know how this stuff works. But I understand if you don't have a background in finance, like I have my master's in finance. If you don't understand finance, maybe your tolerance for risk is pretty low. Maybe you've been burned. Maybe you lost a lot of money in the market before, and your tolerance used to be high, but now it's low, right? So you pick what you're comfortable with and put this in. That's why I have these input controls here, where I can basically collect any type of profile based on the age, income, investment horizon, appetite for risk, right? You can put anything into this model, and it's going to spit out a recommendation for you. So that's why I created it like this, to make it very dynamic, very fungible, very scalable, up and out. It's going to capture any possible scenario and then output the most likely results, right? And then you'll see in just a bit, it outputs a bunch of hypothetical results as well. Okay, so let's move on here. Retirement, enter. Okay, and here is the output. So like I showed before, if you put in high tolerance risk, it's going to put no money into CDs. That's why you have this over here. Okay, so high, if you enter high, you get 0 into CDs. More goes into bonds, stocks, REITs, and ETFs, right? So 70% into stocks. This is going to be 80 plus 1 is 90 plus 1 is 100%. So these add up to 100%. If you did put in low tolerance for risk, you will get some money for CDs. Some are allocated to that asset class or to that bucket CDs. I have none because my tolerance for risk is high. So Control Enter to run this. It's a very basic chart. We're going to plot everything for the next, I think 40 years. I think that's what they have here. So, 25, that's what I said. So year 1, and this is the investment allocation here. So remember, I put in 150K and I'm getting the model to help me make the allocation to these different investment instruments, right? And then and then allocate it according to the strategy that I picked, which is high tolerance for risk, right? And I'm not putting in 150K. I put that as my income, but I'm putting a portion of that 150K into these investments. So if I add this up, let me see if I add it up real quick. How much is this actually taking out of the 150K? Okay. Do 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 do. I think when you make a noise like that, I think it actually makes Excel run faster, probably. Do 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 do. Voice activated Excel. No, it's wishful thinking. Okay, so do 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 do. Something's happening, probably, maybe. Okay, we got something here. I have a pulse. Okay, so how much money is actually going in here? If I put dollar amounts on here, we're putting in 15,000. Okay, so making 150K, putting 15,000, just over 10% of my earnings are going into investments, and that's pretty realistic. I think 10%, 10, 12%. Higher would be like 15, maybe 20%. That's pretty aggressive. And if you can't do it, if you can only do 5%, that's fine too. So let me refresh this chart. Okay, so now we can see the variability of the market. Like I said, you can assume 9% return on stocks, but there's going to be a standard deviation. There's going to be some good years and some not so good years. So here it was about flat. Year 4 to 5, it went up about nothing. That's just about flat. If I zoom in, I can actually zoom in on this. So it went from 50,000 in savings and accounts to actually down just a tad. It just went down a tad. So here kind of flat, up a little bit, up, down. So we had the down year, up year, about sideways, down year, and then a couple up years, and then some big up years over here. So this is for stocks. This is green. I think this looks nice, pretty realistic. And this is one scenario, okay? You're going to see in just a minute, we're going to do multiple scenarios, and then we're going to do a simulation analysis to get a whole bunch of different scenarios. This is just one. It just gives you a general idea. By no means is this a guarantee. You're going to have $896,000 saved up in stocks after 25 years of doing investing. There's no guarantee of that whatsoever. This is kind of a scenario that is pretty plausible and somewhat realistic. But again, in a few minutes, we're going to see a bunch of different outcomes, and the likelihood of each of these outcomes becoming realistic. But this, I think, is a very good start. So you can see CDs are returning close to zero. Oh, I know why that is, because I put zero into the CDs, right? Because I picked high risk profile. If I pick bonds, I have about, that looks like 69,700 invested in bonds. REITs is just under that, 60,000, and I can zoom in and see these numbers a little bit better. So that looks like 69, that's 60,000. And if I go over here, I should see the same thing. So there's 60,000, there's 69 in bonds. That is going to be stocks, 896,000. And what's the ETF? Okay, ETF is going to be over there. And I don't even see that charted over here. So that's interesting. Nothing came up under ETF. Okay, that's fine. I can look into that. If I do the scenario again, just to show you the CD thing. Okay, I'm gonna put 50 years old, 150, 50K. What? Okay, that's fine. 25 years. I say low, so I get some money dumped in the CDs this time, retirement. Okay, so now you can see something is allocated to CDs over here. We're basically adding in the years in this case, because the year didn't come to us by default, and now we have some investments in CDs. So now CDs have 136,000. You can see how the returns are lower. In the last scenario, I said high risk, high appetite for risk. I'm getting more money because the investment is a little bit more aggressive. So, high risk, high reward, but not always. Sometimes high risk and high loss too, right? So now a little bit less is invested in stocks. We have 256 more in bonds, right? Because more is allocated to bonds. Bonds tend to be a little bit safer investment. So if you're low risk profile, you're going to dump more into bonds. So that makes sense. That's why that's more consistent, and more bond returns are more consistent. This is called monotonic line. So if it's constantly increasing, that's pretty realistic for a bond fund, or if you invest in a couple of different bonds. The equities are going to jump around a little bit. So you have a couple down years. Here's a down year. Looks like down a little bit there. That's down. And over time, equities tend to perform pretty well, right? But year over year, there's no guarantee of that. This looks pretty realistic for CDs. You have 136,000. Now CDs aren't generating high returns, but you put so much money into it, after 25 years, you have more money allocated to this investment class. And REITs have about 60,000. Again, this is a little bit higher risk profile. So given the fact that I have entered low appetite for risk, we have less allocation to this type of class. Okay, and I think it should be, that's fine. That's fine. CDs, bonds, stocks, REITs. Yeah, that's fine. Okay. If I saw a mistake, I don't think there's a mistake. So let me do a Monte Carlo simulation. So that was one scenario, right? We looked at one single scenario based on my income, my hypothetical income, my hypothetical time for investing. I put 25 years, the appetite for risk, I entered that. So let's see what we get under this Monte Carlo simulation. Here's the output over here. I can zoom in a little bit and see some of the details here. So basically, Monte Carlo shows you a whole bunch of different potential returns. So here's the higher returns on the upside over here. We could have 1.6 million saved up for retirement. Maybe it's what is this, 1.24 million? Maybe it's 1.14 million. Maybe my savings at retirement is about 1.3 million, right? We go down, as we go down, we have lower and lower amounts saved here. But again, this is a whole bunch of different potential outcomes. We can't predict exactly what is going to happen with the capital appreciation of your investments. That's impossible to do. Nobody can accomplish that. No one can achieve that, right? We have the median, which is the average. The median is probably right around, if I zoom in here, the median is probably right around this line right here, 740K. But then you can certainly have more, right? In this scenario, we have 1.6 million, and you can have less too, $495 million. So that's a big spread between the final outputs here. Are you going to end up with about 500,000 in retirement, after 25 years of making contributions to these different asset classes, or you're going to have 1.6 million. Again, that's impossible to determine. Nobody is going to be able to tell you that. Nobody has a crystal ball. We're just looking at different potential possible outcomes here. That's all this Monte Carlo is. It's a simulation of thousands of different iterations of potential returns, and we plot each one. So if I take you through the code, I'm not going to spend a ton of time on here, but you can see the asset return stats. Okay, so again, average is there, and the standard deviation is there. Average is there, standard deviation is there. So we have simulation results. We're going to append all the results into this list. So we have a list. I do this in a lot of my videos. I'm appending the total portfolios. This is taking a random outcome or a random variable, right, and running these scenarios multiple different times. So where is the time, not the time horizon, where is the number of iterations? I'm looking here. Yeah, so I don't see it, I think. Let me look for this. 10,000, do I see 10,000 somewhere? 1,000? Oh yeah, here it is. So it's 1,000 simulations. That's what that is. So the number of simulations that we create here are 1,000. We're looking at 1,000 different potential separate and distinct outcomes. If you want to change it to 10,000, totally fine. It's up to you. That's how we get the number of simulations. So again, we have the asset return stats, most likely, and standard deviations. We're doing random scenarios, taking everything and appending it to simulation results. And then simulation results actually goes into this data frame right here. This is data frame sim, and we add in a year and then a median year, because remember, we have to get a median or an average value. That is the gray, not the gray, that's like the kind of sky blue, whatever you want to call it. It's like a light blue, I guess. So that would be the median outcome, about 750,000. But again, the outcome is scattered all around that, from 1.6 million down to about 500,000. Okay, so that's how we accumulate, or that's how we achieve the Monte Carlo simulation and the output that is associated with that. Now the chart below is a good start, but the chart above is a good start, but it's a little bit messy because you have all these different scenarios, right? You have 1,000 different scenarios, and it's kind of busy. When you zoom in here, you can see some of the details, right? And here's the median line. The median is the average. But is that really super helpful? I think as a starting point, yes, but as a definitive solution, probably not. I mean, are you getting a lot of meaning or purpose out of this chart? If you are, good for you. I'm not necessarily, but I do think it's a good visual, and I think it can be improved on, right? So I'm taking a concept that I learned from actually from Facebook Profit. It used to be called Facebook. Now I think they call themselves Meta or something like that. So they changed the name of the forecasting tool to, it used to be Facebook Profit. Now it's just Profit. So they had a great idea where they take the median return and then they have an upper and lower um, boundary, sort of like the 75th percentile boundary. This is the 25th percentile. So this is the most likely 740K. If you end up in the 75th percentile, you're going to be above, right? You can get up to 843K. And if you end up like the best case scenario, 1.01 million, that would be the 90th percentile, right? But 90% of the time, you're going to come in below that, okay? So here's the 25th percentile. So 75% of the time, you're going to come in above this, but you could end up with $696,000, right? That's one possible outcome, right? 75% of the time, this could be more than that, but you can't control how these stocks are going to perform. That's obviously impossible to do that. So you just have to accept the fact that 75% of the time you'll have at least 696K saved up for retirement, but it could be lower. The bottom 10% looks like 595, so maybe you could end up with 600,000 after 25 years. Again, we have no say in the matter whatsoever, okay? It really depends on the stocks that we pick, how does the market perform overall, and that's it, right? And these things are outside of your control, so don't even try to control it. So I think that chart is great. I think this was a good first step over here. I think this is a very good chart to present to a key stakeholder or to a client that we're working with if we're creating this financial plan, or if you take this financial plan and go to an actual financial advisor, right, or financial player, financial planner, it's called, not financial player, financial planner or financial advisor. I think this is a great starting point and a good talking point too. So what have we accomplished so far? We did the Monte Carlo simulation, right? The original one-off simulation, right? What could we expect from the outcome from our investments over here? We saw the number one, we saw the 1,000 simulations, right? And we kind of condensed it and just polished it up and came up with this. So I think this looks nice. Now, I want to take this this whole thing and just level it up just a bit. So when I look at this, I know we have age, we have income, we have investment horizon, risk tolerance, and the overall goal. Remember, I said my goal was retirement. It could be a few different things. What did I put in the model? I kind of forgot at this point. What are some of these goals? Goals include, oh yeah, so retirement, wealth growth, income, and preservation, right? So you have 4 potential goals there. So I'm going to take that and create a tool where I can feed all of this into ChatGPT and use this LLM AI model to go ahead and make recommendations for myself. So I have a couple videos basically how this works with ChatGPT. You create a just looking at something here. All right, so you create sort of your risk profile here, right? Well, we already did that, right? Based on the age, I put in 50, my income is 150K, investment horizon, I put in 25 years, risk tolerance. And the second scenario that we're looking at now, I put low. First it was high, and then the goal of both was retirement. So I'm gonna hit Control Enter here and run this process, and ChatGPT very elegantly, very quickly spits out a solution for me. So just look at this, all right? So we have the age, we captured that originally. I'm not going to get it again. That would be redundant and repetitive. And actually, you can accidentally put in the wrong information. I don't want to have 2 inputs. I want to have 1 input. We capture everything at the beginning, and that trickles down or just spills over into the next part of the model here, or the engine, right? Call it whatever you want. You have the triple quotes here. So this is going to be what we're feeding into ChatGPT. So we have triple quotes to open, triple quotes to close, okay? So basically, based on the age, which is a variable, this is a variable, 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 these 5 variables, I'm going to say to ChatGPT, you have a risk tolerance of what? Like I'm giving you my risk tolerance. You come back to me with a recommendation, right? That's what ChatGPT is doing for me. It's giving me a final recommendation. Scenario projection, Monte Carlo median. So all this stuff that we collected earlier in the process, I am going to feed into ChatGPT and say, you give me a recommendation. You tell me what you think I should do. Okay, we already have the one-off scenario. We have the Monte Carlo simulation. Now we want to go to ChatGPT and see what it says. So based on your profile, 50 years old, 150K income, investment price in 25 years, risk tolerance low. That's why I picked the second time. Remember the first, it was high, but we didn't get that down to the step at the beginning, right? That was just to fill in the CD information. So hopefully that was useful because we went out of bounds a little bit there. Investment goal is retirement. So ChatGPT says you have a low risk tolerance with 25-year horizon, making you well suited for a conservative portfolio. Okay. Scenario projection 752,000. Monte Carlo median 785. So we got that from the prior steps, right? Suggested actions. So this is where it gets very interesting. Rebalance annually to stay aligned with your goals. Yes, I agree 100%. Consider increasing your contribution if possible. Again, agree 100%. Monitor for changes in income, expenses, or retirement age. Again, once again, 3 times the charm. I agree 100% with what ChatGPT is recommending here. Would you like to model early retirement, change asset classes, or test downside scenarios? What if your risk tolerance were moderate or the horizon were greater than 25 years? Estimated portfolio value 978. So given this scenario, we're seeing about 785, 750 ballpark, maybe 770. If we chose a moderate risk tolerance, which in that case you would dump more into stocks and less into CDs, and a little bit more into REITs, a little bit less into bonds, and so on and so forth, you could potentially get 970 in capital gains, right? Or accumulated wealth, whatever you want to call it. They're kind of different, but in this case, it's basically the same. But again, there's no guarantee of that, right? So you can have more, you can have less. So let's go ahead and plot this out so we can see what the results look like. So scenario versus Monte Carlo portfolio. So my scenario, we have some invested in CDs, about 63K. Bonds have 193. Stocks have 419. REITs have 75K, and the total portfolio is going to be about 752. Monte Carlo median is 740. The total portfolio is 595, and then the total Monte Carlo portfolio at the 90th percentile is 1.15, right? So Monte Carlo median 740, most likely, or wait, what's the gray? Oh, the median. Okay, so the median is the middle. That is going to be about 740. That's the Monte Carlo, Monte Carlo simulation. And that's the most likely, that's the median. The lower 10th percentile would be a little bit lower. Obviously, in the higher 90th percentile, it's going to be a little bit higher. So that aligns perfectly with what we see over here. This is the 90th percentile, right? So 928. Here's a little bit lower. This would be the lowest 10th percentile, 595. So it's the same concept. You have 90% chance that's going to be lower than 928, 10% chance that's going to be greater. You have 10% chance that's going to be lower than 595, or 90% chance that's going to be higher. Okay, so you kind of take those and sort of invert those, if that makes sense, hopefully. So we saw the plots over here, and then I can go ahead and make another request to ChatGPT. Now I've saved this on my desktop. You would have to go ahead and create this text file, open key API text, put in your ChatGPT API key, and I'll show you where to find it. I guess I didn't put it over here. That's fine. So let me go over here, ChatGPT. No, google.com. I think you can Google it and find it, but I'll give you the link anyway. So ChatGPT API key. Yes. We're looking good. Create an open API key. That looks good to me. Here's the keys. So you can see mine is going to be blotted out here, but these are my keys. They always start with SK with this kind of combination. And then it's going to be whatever your key is, right? So you have to generate your own. It is not free to do so, but it's very, very, very cheap. and I would highly recommend you to do that. And you can look at the rates. You can even Google rates. I guess I'll do that quick. What do we have for rates? APT key rates usage. It's pennies on the dollar for they're called tokens. You would take a token and pass it into ChatGPT. So model versions have different prices. 3.5 is faster than 4.0, but the response or the recommendation isn't quite as accurate. That's why it's faster. It's also cheaper too because the product, the ultimate output or report you get, isn't quite as accurate as GPT-4. So this one is faster and cheaper. This one is slower and more expensive. Okay, so you can look at the rates over here. It's pretty cheap, guys. I've been using this for a long time, and I haven't paid a whole lot. I think I've been using this thing for maybe 6 months to do all kinds of stuff, and maybe I paid $20 or something like that on my card. So it's pretty cheap. So anyways, I'm going to control enter to run this thing, and let's see what kind of response it comes back with. Here's the key. You can go ahead and get your own key. Again, it's not free, but it's very cheap, guys. It's totally worth it. Whatever you pay. Again, I think my bill was about $20 in 6 months, which is not free, obviously, because you're paying, but it's pretty close to free, guys. But look at the service that you're getting. So I just entered the all the information that we collected above, the Monte Carlo simulation, the investment allocation, right? It's giving me recommendations over here based on your profile. We recommend rebalancing, increasing contributions, monitor changes for income, expenses, and retirement age, right? So that is fantastic to get started with. Now it goes into more detail, right? We drill down to another whole level to get more granular reporting or results here. So review your financial goals, make sure your investment goals are clarified. Are you saving enough for retirement? So on and so forth. That's good guideline to follow, right? That's good to know. Diversify, keeping your portfolio as diversified as possible can help manage risk. That's totally true. Continual review. Set aside some time to regularly review, and if needed, to rebalance your portfolio. Kind of reiterates a little bit what it recommended before. That's fine. Hire a financial advisor. So that's what I said several minutes ago. If you are open to that, by all means, then pursue that option. Consider risk tolerance. Since you mentioned you have a low risk tolerance, ensure that investments mirror this. Okay, so yep, it's right on par with where we would expect this recommendation to be. Invest regularly. Consider dollar cost averaging. Great option, right? Like I didn't mention that before, but the model is coming back with that. And by the way, I'm using ChatGPT 4, so this one's a little bit more expensive. It's a little bit slower, but again, the response that you're going to get is going to be more refined and almost guaranteed to be more accurate as well. So invest regularly, dollar cost averaging, great advice right there. You nailed it. And then in conclusion, these figures provided by the scenario analysis and Monte Carlo simulation are estimates. That's what I said several times. They're not guaranteed outcomes. Please consult with a financial advisor before making any major investment or adjustment to your investment. So that's a ton of stuff. I know, guys. I know. I've been doing this for a long time, so it's all in my wheelhouse. I'm very comfortable with, the terminology, the Python coding, all the financial concepts, and execution and strategy and planning. So I know how this stuff works. If you are watching this video and you feel a little bit overwhelmed, that's fine. Take a pause, have a sip of cold water or something, relax, watch the video a couple times if you need to get it. Do some Googling, talk to ChatGPT to get some information from that, right? The benefit of using Python with ChatGPT and integrating these two together is that you can run these simulations, right? You can input all this information. Now you could probably get some of this from ChatGPT too, but I think the combination of Python and this AI tool, this LLM that's available to us, is a great combo. I think it's a great combination. So I have a few videos that explain how to integrate these two systems or tools or technologies, whatever you want to call them. And I think the combination is fantastic. It's synergy. 1 + 1 = 3 in this case, right? You get more out of it than what you put into it. So that's pretty much it. The video is at just about 35 minutes now. I think that's long enough. I think we beat this horse. We answered the question. We created this personalized investment recommendation. I don't think any questions that I introduced have been unanswered. But if you have additional questions, put those in the comments. If there is something, some improvement or whatever, put that in the comment. I like to get feedback from people. I don't get a whole lot, to tell you the truth, but it's good to get that feedback. And then I can pivot accordingly or plan, or if I make future videos on this topic, I can, um, take that into consideration and incorporate that into the next video. So yeah, I'm going to wrap it up here. We're just bumping our head at 35 minutes right now. That's a ton of stuff. I know, I get it, I understand. But if you spend a little time with this, you can get acquainted with it pretty easy, and the payoff is going to be huge, guys. You'll get out way more than you put into this. Okay, so I'm going to wrap it up, and I will see you guys in the next video. And by the way, I'm going to share all this code with you so you can copy and paste it and run it in your own Jupyter environment. I'll save the code right now, save it as an HTML file. I'll post the code when I post the video, and you can just download the code. It's one click to download and one to open, I think. You'll have everything you need right there, and you can jump in and have some fun with this. Okay, so that's it, guys. I'll see you soon. Take care, and catch you in the next one. Bye.